Hello traders, in your trading journey, you will discover that as the market trends upwards or downwards, it displays certain patterns that are often clearly visible with time. This video seeks to enlighten the viewer on the various stages that a trend assumes as is often visible on a Forex trade. At the same time, viewers will be able to understand how various categories of traders position themselves as the market trends in either direction, that is, as it trends upwards or trends downwards. In Forex trading, a trend refers to the general direction in which the market is moving. Forex trends are usually classified into four main stages that include accumulation phase, market phase or markup phase, distribution phase, and markdown phase. As you engage in trading, it is imperative that you get a clear understanding on each of these stages, since it will help you to identify the potential areas where you can either take your positions or exit the market. Without such an understanding, you will often take positions in the opposite direction to the market, and you will end up incurring losses in trends that you'd have otherwise made admirable profits. So let us now take a look at each of these phases. The first phase is the accumulation phase. The accumulation phase initiates at the conclusion of an extended downward trend in an exchange rate or a downward trend in the market or in a market trend. This phase usually commences when the exchange rate, market trend or market price approaches its lowest point. During this stage, most retail traders are hesitant to take long positions, or they are not usually willing to take buy positions since they have become fearful from the losses they incurred while the market was declining. Another cause of fear may be since they are not sure whether the market will continue declining or will begin rising up. However, it is worth noting that at the time that most retail traders are avoiding taking long positions, smart money traders, recognizing the value and opportunity, enter buy orders at the key support levels. The actions of smart money traders play a significant role in markets since they prevent the market from continuing to decline and at the same time attract additional buyers to take long positions. Usually, traders who are experienced often wait for confirmation of directional reversal before they can enter the market so as to avoid buying or taking long position at the absolute bottom. The next phase that you'll be looking at, the next stage, is usually referred to as the markup phase. Markup phase follows the accumulation phase as the market participants develop a shift towards a positive market sentiment. This phase is usually characterized by more traders entering long positions, which further elevates the market price. The action of the market participants usually generates enthusiasm for the new uptrend. Typically, inexperienced Forex traders often join towards the end of the markup stage. This is often as a result of fear of missing out on the strengthening upward move. And it is usually not advisable to take positions when the markup phase is nearing its end, because often the end of markup phase, as you will see, results in distribution, or else, as you will see later on, can have an instance where a trader loses money when the market reverses or enters the markdown phase. So the next stage, or the third stage, is usually termed as the distribution phase. At this phase, or at the distribution phase, professional selling interests are usually become exhausted, causing the exchange rate and the market confidence in the upward trend to rise to new swing highs. Retail Forex traders and other members of the public with little or no professional trading experience usually start entering the market. As the novice traders buy near the top of the market, and as this stage progresses, the smart money starts distributing their long positions to take profit and sell into this strength that is now largely based on public interest. So the thing here is that while the smart money are preparing to take long positions, retail traders, while the smart money are preparing to take short positions and or exiting their long positions, the retail traders are usually still bullish on the trend that is trending upward, or that is the moment that they are entering their long positions, which makes them make high or huge losses. The distribution phase typically displays considerable overlapping exchange rate, or it displays considerable overlapping exchange rate moves as the buyers and sellers compete for dominance. That is because the smart money is trying to short while other market participants are still long, and they are still trying to maintain the trend in an upward trajectory. However, the market eventually tops out and begins to decline at this stage, or as this stage comes to an end. Now, the next and the final phase is the markdown phase. In the markdown phase, the market has already peaked and continues to decline as professionals increasingly establish short positions. So basically what we are saying is at this phase, or it begins when the market trend has reached its peak, and professional traders now are usually increasingly taking sell positions. Inexperienced traders may persist with the long positions, however, anticipating that there might be a final rally, or the rally might continue in its direction, or in the direction that it was ending. As confidence wanes among the general public, selling interest intensifies. The exchange rate decline accelerates until it loses momentum, ushering the market back into accumulation phase as the cycle repeats itself. So basically what we mean is that The markdown phase usually begins at a time when the market has reached its peak. During this time, there are still numerous retail traders that are trying to take long positions, thinking that there might be another rally that will continue as the market trends in the direction that it was trending. But then at this time, experienced traders are already taking short positions, which makes the market to decline further. And this declines till the market bottoms or reaches a level where it will now begin the accumulation phase. And then it can repeat the cycle and so forth and so on. Typically, these are all the stages that we have discussed are the stages involved in a Forex trend, or in actually most markets, or in any market. We finalize by highlighting that understanding these stages in a Forex trend is pretty valuable for traders. It helps traders to make more informed decisions about when to enter or exit positions, and more importantly, to manage their risks effectively. Thank you for watching. As usual, let us meet again in our next trading video, which we will be uploading very soon.